Welcome back to FX Street. It's 10 a.m. Eastern. Today is Wednesday, August 17th, 2011. Welcome back, one and all. Great that you could join us. Ed's the best. We used to work together about 1,000 years ago. Okay, we're going to get started. And the topic that we were supposed to talk about yesterday, which we will talk about today, is finding the best currency pair. And before we get to that, well, quick piece of news. PPI, U.S. PPI, Producer Price Index, was released at 8:30 this morning. A little bit of positive news, actually. If you recall, last month the PPI was negative, a negative inflation rate on the producer level, down 0.4%. This month it was up 0.2%, but what's really interesting is that the core PPI, the Producer Price Index, if you take away food and energy, which are more volatile, oil prices are high, gasoline prices are high, if you take that out, the number was actually even better. And we want to see prices continue to rise because that's a symptom, that's a sign of a good economy. Okay, now we have a lot to talk about today. This is Dow Jones Special Average, 11,490 in the futures. Former support could become new resistance as soon as 11,600, which is about 108 points from here. I assume everybody else, okay, can hear me. If you cannot hear me, please log in again. Okay. So 11,600 could be the top of what arguably is a new trend to the downside in the Dow that coincidentally coincides with a 50% Fibonacci retracement level off of our recent swing highs. Or we could be more optimistic and see a much higher high. Former support could be new resistance or uptrending support near 12,000. So as far as I can tell, I think that we're probably going to spend the latter days of August in the trading range. We know this because the volume in August tends to be anemic at best. We had an exuberant amount of volume and volatility in the latter parts of July and the early days of August. All that has passed. Very few economic numbers going to be released. I think the Eurozone GDP numbers were released yesterday. Germany, the numbers are not so good. We have U.S. GDP numbers, but that's later on this month. But that's about it as far as the really big headline numbers. Not a lot of central banks are scheduled to speak or anything of that nature. So don't expect, today is a big day. We're up 91 points in the Dow, but I would not expect big days. More range-bound trading as we close up the month of August and early September. However, right around the corner, October, another earnings season, does represent some historically high volatility trading. So quiet months will follow good months. Now the topic of the day is finding the best currency pair, and I promise I'm gonna show a correlation between the two. You should see though this Excel sheet that I've been sort of maintaining, and this ties into what we're going to talk about today, which is finding the best currency pair, which is really putting the strongest pair with the strongest and the weakest currencies together to find the best currency pair. This chart, please let me know if you do not see it. You should see a blue, red, and green line. Now the blue line is the TNX, which is a symbol for the 10-year U.S. Treasury bonds. The red line is the TYX, which is the 30-year Treasury bonds. And I can actually type this in just to keep track. And I promise, okay, so the TYX is the 30-year. TNX is the 10-year. All right, you have that little key. Okay, whoops. What did I write? TNX equals the 10-year. Now, the stock markets, I'm typing this in wrong for some reason. TNX equals 10. There. Well, I don't know. For some reason, it's not letting me, it's not letting me do it. Okay, at any rate, the stock market's a lot more of an emotional market. If you want to trade foreign exchange and you want to look for other markets to look for signs of confirmation, look to the bond market, specifically the 10-year bonds. We like to compare the yields in the 10-year bonds from different countries. The yield on the 10-year bond in the U.S. is right now it pays 2.24% yield. The 10-year bond yield in Australia pays 4.49%. As optimism grows, as stocks rise, as it's anticipated that the central bank will raise interest rates, expect to see higher yields. We have bad times, when the stock market drops, when we expect the central bank to lower rates, we expect the yields to go down. Okay, that's the basics. Now, within the U.S. or any country, we can also compare the short-term and long-term bonds. And I find this very, very interesting. The blue line, again, is the short-term bond. That's a 10-year bond. The red line is the 30-year bond. Now, what we want to do is compare the difference between the two, the spread. The 30-year bond right now, the yield is 3.67%. The 10-year is 2.24. 367 minus 2.24 is 1.23. There's a 1.23% difference, or 123 basis point difference between the 30 and the 10-year bonds. Now, the green line represents that difference, that spread. You'll notice we're near the high. Now, if you look at, and I promise I'm going to get to the topic of the day, but this really it's very important to try to draw the correlation. This chart here shows the spread, which is a red line, and the blue line is the Dow Jones Industrial Average. Okay. Now, during prosperous times, if you notice in the late 90s, 1998, 99, 2000, stock market obviously went up. That line, that red line, the spread between the two yields went down. Think of it this way. What do I think about the economy in the near-term future? That's the 10-year bond. I think it's okay. What do I think about the economy in the long-term future? The 30-year bond. Well, whatever I think about what's going to happen in the short term, I think the long term is going to be better. I mean, it goes under the premise that things should always be better further out into the future. That the world will be a better place for our children than it is for us. That's basically what the bond market's telling us. Well, in the late 90s, when the stock market went up, the yield, the spread between the short-term and long-term bonds contracted. That's why this red line went down. Because the 10-year bond yield is always going to offer a little bit less than the 30-year, but the difference between the two is going to contract. They're going to move together. The spread's going to tighten, so to speak. When the stock market crashed in 2001, 2002, well, all of a sudden, the yields on the 10-year bond dropped a lot more than the 30-year bond because, over the long term, I expect things to be okay, but right now, things are really, really scary. So, in other words, when the stock market goes down, this line, the spread line, will go up. What are we looking at now? What's my point? Well, yesterday, the spread, the difference between the 30 and the 10-year bond, as far back as my charts go back to 1985, hit an all-time new high. In other words, that the yield on the 10-year bond was so much lower than the 30-year bonds. Now, this is the chart that really tells the whole story. The blue line is the Dow Jones Industrial Average. Those two lines, the green and the purple line, represent a 10-year and 30-year bond. And obviously, the green line, the 10-year bond, will naturally fall below the 30-year because the yields for the short-term bond will naturally be less than the long-term bonds. 10-year will be less than 30 years, what I'm trying to say. Notice at the bottom, this red line is a spread, but we can sort of extrapolate that our basic trend to take place. Starting in the early to mid to late 90s, stock market was strong, the economy was expanding. We had a general trend to the downside. The spread over the course of 10 years in the 1990s, as the economy improved, the spread, the difference between the two, smoothing out the fluctuations, declined. Because what happened now, and what we expect to happen now, and what we expect to happen in the future, well, things are great right now, and I think things will be great in the future, but things are really good right now. Now, once in a great while, the yield on the 10-year bond actually is higher than the 30-year bond. That the stock market is so strong in 1999-2000 that actually the 10-year bond, that things are so good now, they're actually better than I think they're going to be a long-term into the future. In that case, you have an inverted yield curve. And that's when this red line dips below zero. That is a huge sign forecasting a recession. That signal occurred in the year 2000, and it occurred very briefly again in 2006. On the reverse side, from 2001, 2002, we know the stock market crashed. All of a sudden, well, we're not so optimistic about the long-term future, but things right now look even a lot worse. And we saw a general trend to the upside in the spread. That's what we're seeing now again. And that's why I wanted to try and get to this point here as quickly as possible. The difference between a 30 and a 10-year bond is now at historic highs, the spread. Meaning that, yeah, I'm not so optimistic about what's going to happen in the long term, but right now in the short term, things are so pessimistic as far as the bond market's concerned that the spread's an all-time high. Now, the Federal Reserve last week, let's connect the dots with the fundamental data. Federal Reserve last week, they met, they said, we're not going to raise interest rates until 2013. And I read an interesting article in the Wall Street Journal over the weekend. What the Federal Reserve is trying to do is push investors into the long-term, little bit of a higher risk bond, meaning the Federal Reserve wants the consumers, wants the market to buy the 30-year bond because they're trying to fight the spread. Right now, what's everybody doing? They're buying the short-term bonds. That's why the 10-year yields are so low. When you buy the bond, the yield goes down. Price goes up, yield goes down. The Federal Reserve doesn't want that, but the bond market doesn't care what the Federal Reserve says. The bond market, which I always believe is one of the smartest markets in the world. It's a lot less emotional than the stock market. You know, the stock market, we talk about Facebook and Google and IPOs and mergers and acquisitions. The bond market doesn't care about that. Bond market doesn't care that Google bought, mobile or Motorola, mobile, whatever it is. Bond market looks at economic data, PPI, GDP, etc. And right now, despite high stock prices, the bond market's still telling us, look, we're buying the 10-year bond because we don't even have faith in the 30-year bond, not as much as we do the 10-year bond. Now, how do we draw the connection to the foreign exchange market? Well, we know currencies tend to move under the anticipation of higher or lower interest rates. I didn't do it. It's actually an interesting thought, though. If you were to overlay the historical interest rates in the U.S., when is the Federal Reserve most likely to raise interest rates? Well, when economic numbers tell us that the Federal Reserve should raise interest rates. Inflation is rising, employment is rising, GDP is rising, all that good stuff. That's what we want to see. Well, right now, and we kind of remember in the year 2001, remember after the stock market crashed, that the Federal Reserve started to reduce rates very, very fast? Well, at that point, the bond market said, hey, the Federal Reserve, we think they're going to reduce rates. And as a result, they actually, I think, started to cut rates beforehand. And as a result, well, that this trend to the upside, the spread in the yields started to widen. Stocks went down a lot, and the Federal Reserve cut interest rates, and eventually we hit a bottom. Well, we broke this trend line on this trend May of 2003. That's when the stock market sort of hit a bottom and started to actually recover to the upside. Federal Reserve started to raise rates. What happened when they raised rates? The spread between the two bonds narrowed. So this is a very logical way to anticipate when the Federal Reserve is going to make a move. So far, the Federal Reserve has said, we're not going to make a move. We're not going to raise rates well into 2013. The bond market agrees. And the bond market's saying, you know what? I don't want to buy the 30-year bonds. If the Federal Reserve is not going to raise interest rates, I want to buy the short-term bonds. That's why the yields on the short-term bonds have moved down so much faster than the long-term bonds. Now, if you really want to get complicated, if you really want to do a good job at this, go through the same exercise with the bond markets in Germany, Eurozone bonds, but Germany would be the best way to look at a Eurozone. UK, Australia, New Zealand, look at all the different countries. I mean, that is how amazing and how in-depth foreign exchange trading could be. I mean, could you imagine if we had the time to actually go through and compare the short-term and long-term bonds for the 8 different currencies that we follow? Well, we'd get a much, much better idea about how soon or how likely is the European Central Bank to raise interest rates. How soon or how likely is the Reserve Bank of Australia that they may cut rates? Look at the Aussie bond market. Question is, have you or do we trade bonds? I don't currently trade the bonds in the form of bonds. I trade options on the bonds. And I'd like to one day trade the futures on the bonds because I think that's really where the action is. Bonds, to trade bonds, you need a lot of money because they don't move a lot. So traders will trade the futures. It's a fantastic barometer to watch though. Okay, let's get to the topic of the day. I just wanted to sort of share that because the foreign exchange market, when I started out, I said, you know what, here's a daily chart of the euro dollar. I'm going to plug in the RSI. I'm going to buy it when it's a little oversold, and I'm going to sell short when it's a little overbought. And I made some money, lost some money. I think I lost more money than I made. But I started to get, from the beginning, I was a stock trader. I was a day trader. I was a tape reader. I didn't care so much about the fundamentals. I wanted to know what's going to happen 5 minutes into the future and 10 minutes into the future. I could not care less about PPI. But over time, as I became more involved in looking at the mechanics of the foreign exchange market, why it works, and this gets right to the topic of the day, I started to realize there's so much more that's involved in the foreign exchange market. And we follow 8 different currencies, the euro, the pound, the dollar, etc. Each one of those currencies has its own issue. Now, it's pretty easy right now to identify the issues at stake. We know employment in Australia, all of a sudden, 5.1% unemployment, it ticked up from 4.9. Australia is seeing a little bit of a slowdown, and some analysts actually expect the Reserve Bank of Australia, Analysts from Australia, Goldman Sachs, I read, expect the Reserve Bank of Australia to cut rates as much as twice before the end of the year. European Central Bank, that was expected to raise rates again in October, now they're expected not to. Federal Reserve, the market thought that maybe the Federal Reserve would raise rates next year. Now the Federal Reserve says no, 2013. It's easy to talk about the issues now because they're really big headline issues. But sometimes the issues are not so obvious. The bond markets do a very good job of telling us the truth. Do FX pair euro follow the spread of 30-year bonds or just the U.S. bonds? Well, the U.S. bond market is most directly correlated, obviously, to the U.S. dollar. If you want to, look at the insides and mechanics of the euro currency, look to the European bonds, specifically the German bonds. If you want to know an easy way to start out, look at the 10-year bonds only from the different countries. The 10-year German bunds, the 10-year U.S. bonds, the 10-year Japanese bond, Aussie, Kiwi, etc. And you can chart those and you can start to see, changes between the bonds. Now, obviously, the bonds in Greece and Portugal and Spain, they're going to offer much higher yields because there's a real risk of credit defaults. The bonds in Australia are going to offer a higher yield because there's higher interest rates in Australia. So there's a lot to it. But if you want to start out an easy way, which is how I started out, compare the 10-year bond yields between the two. Let's get to the topic of the day. We want to find the best currency pair to trade. This is always a different answer. There's a simple exercise I've talked about in the past on previous webinars. I think it's a really easy way to identify which currency pair has the best momentum, the best direction, and or the best trend, I should say, and which direction that trend is moving. We want to look for currency pairs that trend. I'll give you an example. The dollar Swissy. There's a dollar Swissy. I know it's a messy chart, but take a look at the dollar Swissy. Long-term trend to the downside. If we had decided to sell short the dollar Swissy, place a protective stop, and if we didn't get stopped out and we forgot about this trade, it's very possible we could have made 50 pips, 100 pips, or several thousand pips because there's a very strong trend in the dollar Swissy. The same holds true for the euro Swissy. Another one. The euro Swissy has had such a strong trend to the downside that the Swiss National Bank and the Swiss economy, being hurt by the strong Swissy, has actually talked about maybe setting a limit, a target, that they're not going to let the Swissy go up anymore against the euro. I don't know necessarily that's why the euro Swissy is recovering. I think there's other reasons at work, including the fact that gold, which benefits the Swissy, is selling off. But the fact of the matter is, we want to find a currency pair with a trend. Now, I plugged in below this indicator. It's called the Rsi Indicator. It stands for Relative Strength Index. It measures the relative strength of that currency pair on a scale of 0 to 100. Indications above 70 are considered to be very strong. Indications below 30 are considered to be very weak. Now, typically a buy signal occurs when the RSI line crosses below and back above 30. A sell signal occurs when the RSI crosses above and back below 70. The RSI indicator is free on almost all charts out there. That's why I like to use it. So all of you can go through the same exercise. We're not going to look for buy and sell signals in a normal way. What we're going to do is we're going to identify the relative strength of each individual currency. Now, right now, the RSI on the euro dollar says 57. Now, what does that mean? And I'm gonna chat all this in to keep track of it. Okay, so the euro dollar RSI equals 57. What does that mean? Well, when we buy a currency pair, we're buying the first currency in the pair, and we're selling short the second one. If I buy the euro dollar, I buy the euro and I sell the dollar. Okay. So we know this is on a scale of 0 to 100, the RSI indicator. So what we want to do is the relative strength index. Exactly. It's a strength index. What we want to do is we want to interpret what does 57 on the RSI mean. 57 on a scale of 0 to 100 means that the euro is 57 and the dollar is mathematically it's called a complement, which is 100 minus whatever that number is. 100 minus 57 is 43, right? Does everybody understand? That's the basic mechanics. That's as complicated as we're going to get. Okay? Again, the RSI, the relative strength index, this little squiggly line, and I always use daily charts, says 57. If you look at the euro dollar and you want to find out what the relative strength is for each individual currency in the pair, well, when we buy the euro dollar, we're buying the euro. That's the first currency. So the RSI, that number is always going to be the first currency. The second currency, the dollar, is going to be 100 minus that number. So the RSI is 57 on the euro dollar. That means the euro is 57. And the dollar is 100 minus 57, 43. What we're going to do is go through the daily charts, plug in the RSI, oscillators, relative strength index. Always use the same time frame charts. So the pound dollar, we're going to round this up, 62.95 is 63. So pound dollar is 63, right? We're going to look at the Aussie dollar daily chart, insert indicator, oscillators, relative strength. Aussie dollar right now, 51. Does everybody understand? Please let me know if I lost anyone. What did I say, by the way? I said 51. Okay. Okay, so Aussie dollar 51. It's a very simple exercise. The good news about the daily charts is they don't change very often. So we go through this exercise once a day, maybe once a week, more than once a week. 50 on the Kiwi Dollar. And by the way, that tells us that exactly the Kiwi and the dollar have the same exact relative strength. What have we missed? Okay, now let's go through the dollar Swissy. Insert indicators, relative strength. The dollar Swissy is 53. But we want to compare apples to apples. So you cannot, if we talk about the pound dollar and the Aussie dollar, that's not the same as looking at the dollar Swissy, because the dollar is the second currency in the pair in the Aussie dollar. In the dollar Swissy, it's the first pair. So we have to take the inverse of that number. Basically, I'll write it this way. If the dollar Swissy equals, what did we say, 53, then what we really want to do is find out what the Swiss dollar is. The Swiss dollar equals 100 minus 53 is 47, right? Because it's 100 minus 53 equals 47. So everybody understand? Okay. So I'll type again. Swiss dollar, 47. We always talk about the dollar Swissy, meaning the dollars first, but we want to compare apples to apples, not apples to oranges. The process only shows the strength to this moment, or does it last long on a daily chart? Great question. On a daily chart, you're going to notice that the RSI doesn't move very, very fast. So if you run through this exercise in a 5-minute chart, yeah, then you're going to have to run through this exercise every 5 minutes, so to speak. I like to use daily charts because I want to identify the long-term trend. Because a short-term trend, maybe the Euro Swissy, when we looked at it, didn't have a strong trend to the downside. But if you look at a long-term daily chart, sure, it tells us Euro Swissy is very weak. Okay. Dollar, yen, RSI, oscillators. And this is something I kind of made up on my own. Nobody told me about this. I hope it makes sense. 34 on the dollar yen. I think, yeah, Sundays is a great idea. 34, then the yen dollar equals 100 minus 34 is 66, right? 66. Okay. You could use stochastics, I suppose. I think you probably could. It's a little bit more difficult to interpret, though. And some stochastic, you have the stochastic indicator and you have the stochastic oscillator. I like to use the RSI because it's so simple, it's so straightforward. The scale is 0 to 100. The dollar CAD right now is 53. Dollar CAD. Dollar CAD equals 53, so the CAD dollar equals 100 minus 53 is 47. Okay. I think I covered everything, right? Now, let's put these in order from strongest to weakest. Okay, so the pound is 63. The ADX, well, the ADX, the advanced decline line, that looks the market from a different point of view. The RSI very simply measures the market's, the relative strength of the previous 14 candlesticks. I haven't tried the ADX. It would be an interesting idea, though. I think you could take any oscillator that gives you some sort of predefined number, like the ADX, or the stochastics, or the RSI, or the MACD. But I like the RSI because it's on a scale of 0 to 100. So it's very, very simple. And I promise you, I mean, this is something I kind of made up on my own. 99% of the Forex traders out there would not only don't use this approach, but probably think I'm kind of crazy for doing so. But so this is a kind of a unique approach. But I encourage you to try it. I mean, experimentation is the way to go. That's the way that we learn. Nobody ever told me to look at the bond yields. Bloomberg actually, I heard an article about it. Strongest to weakest. My best ideas come from just, trying to think of a new creative way to look at the market. Let's look at our indications and try to figure out what it says. Okay, so the highest number right now, remember with the dollar yen, we want to look at the yen dollar. The dollar Swissy, we want to look at the Swiss dollar. We want to compare apples to apples. American ingenuity, I love it. Okay, so the highest number I see right now is the yen, correct me if I'm wrong, followed by the pound. Okay, so the yen is 66, the pound is 63, the euro is 57, the Swiss dollar, okay, I'm scanning back on my charts here. So the Cad dollar is 47, the Aussie's 51. Do I have anything? Can I beat 51? No. So the Aussie's next. Aussie's 51. Kiwi's 50. That makes it easy. Kiwi now. After the Kiwi, we have the Swiss dollar, which is 47. Am I missing something here? Swiss dollar is 47. And I'll put, the yen. Did I make a mistake? No, the yen is right. The dollar yen is 34. So remember, the yen dollar is actually 66, which is in the front of our list. Okay, so we have yen 1, 2, 3, 4, 5, 6. I'm missing. The dollar is one currency pair I'm missing. So yen, pound, Aussie, Kiwi, Swiss. Oh, where's the CAD go? Don't forget about the CAD. CAD dollar is 47. CAD. I'm going to put this in parentheses because the CAD and the Swiss are actually the same indication. The Swiss is 47 and the CAD's 47. Okay? But what about the dollar? The yen, pound, euro, Aussie, Kiwi, Swiss, and Swiss/CAD being the two of the weakest. But where's the dollar in all this? Well, remember that when we look at the pound dollar is 63. And that means the pound is 63 and the dollar is 100 minus 63, 37, right? So the pound is definitely stronger than the dollar. The euro dollar is 57. And that means the euro is 57 and the dollar is 100 minus 57, which is 43. So the euro is definitely stronger than the dollar. It actually makes it really easy because the Kiwi dollar is 50. We want to put the dollar right in the middle, above the currencies that it's stronger than, and below the currencies that it's weaker than. Now, in terms of the Kiwi, it's very simple because the Kiwi dollar currency pair is 50 on the RSI, so it's exactly the same. And look, if it's up, if I'm wrong by a point or two, it's okay, it doesn't matter, because we don't want to compare two currencies that are very close together. We want to look at the opposites. So Kiwi and dollar are 50. They're equal. That makes it easy. USD, okay. After that, we have the Swiss and the CAD. That's strongest to weakest. Sorry about capital letters. Can we say that the strongest yen is the most close overbought? Well, great question. You read my mind. That's the next thing I'm talking about. Before I answer your question, let's just identify what's the strongest and the weakest. The strongest is the yen. The weakest is the CAD or the Swissy. Well, the Swiss yen, it's actually a really interesting story about the Swiss yen currency pair. Some of us don't trade it though. So we would say the Cad Yen. The Cad Yen is the currency pair that has the strongest trend. And the trend is obviously to the downside. I'm going to go to the Cad Yen currency pair charts on a daily charts. And just out of curiosity, let's plug in the RSI and see what it tells us. This better look good. Yeah. The RSI in the Cad Yen is 36.5. It has recovered, but arguably there's a pretty strong trend to the downside in the Cad Yen. How often do I perform this exercise? Well, definitely every time I host this webinar on FX Street. This is one exercise that I've incorporated into a much bigger routine, with my repertoire. So, but on a short and long-term basis, in one form or another, I'm constantly doing this throughout the day. Now, I have a little bit of a different system for doing this that makes things faster. But if you want to go through and do this, I think the best thing, start with daily charts. You take out a piece of paper and, put together 7 daily charts, Aussie dollar, euro dollar, pound dollar. And you're going to find out if you're going to do the exercise very, very quickly. You're going to do it 3 times and you're going to be able to look at, euro dollar 57, write down 57, pound dollar 63. Very, very quickly, you'll be able to, it's a great way to start the trading day because you get a reference for the strongest trend. And you also get a reference for the weakest trend, the Kiwi dollar. The Kiwi and the dollar are both 50. That shows us, and if you look at the Kiwi dollar currency pair, 49.75, it shows us the Kiwi dollar has very little reason to move, whatever the reason. Now, before I get to your question, Milan, let me go back for a moment. The strongest currency is the yen. The weakest one is either the Swiss or the CAD, either or. Now, fundamentally speaking, take a step back, think about the Swiss and the yen, Swiss yen currency pair. The yen is the strongest currency, the Swiss is the weakest. What's the difference between the two? What do they have in common? Both economies, Japan and Switzerland, do not like a weak dollar because a weak dollar makes the yen and the Swiss franc very, very expensive. Both central banks have taken different measures to stop the dollar yen and Swiss yen, dollars yen and dollar Swissy from going down. Both have intervened. The Bank of Japan in the past week or 2 weeks, largest intervention ever by the Bank of Japan. Now, when the Bank of Japan intervenes, it's serious business. And it really hurts those euro yen, dollar yen, Aussie yen shorts. Not to take anything away from the Swiss National Bank, but it seems like the market didn't pay attention to as much the Swiss interventions. That's my opinion. But if you look at the exercise we've gone through, the yen is the strongest and the Swissy is the weakest, it actually shows the opposite. It actually shows that the Bank of Japan, despite intervening, the yen is still going up. The yen is still strong. The Swissy is starting to reverse. Maybe the threat that the Swiss National Bank is going to peg the currency to the euro, maybe that has created some sort of ceiling for the Swiss currency. But nevertheless, on a very technical basis, and a technical analysis never lies, the charts tell us what the charts tell us. It's told us that the yen, especially if stock markets go down, because traders tend to like to buy the yen when the stock markets go down. The yen, the dollar yen to the downside makes a lot more sense than the Swiss yen. Now let's get back to your question. Can we say that the yen is most close to being overbought? The answer is yes. I'm talking about the Cad Yen in particular. Go back to the Cad Yen daily chart. Remember the RSI, the way we're supposed to use it, the way it was designed to be used is that we buy the currency pair when it crosses below and back above 30. Now we just ran through this exercise right now, but I'm willing to bet that if we had done this, let's say on August 10th, just last week, we would have seen a much greater divergence between the yen and the CAD. The yen, remember, the yen dollar currency, the RSI was 66, and the dollar CAD, or the CAD dollar, was 47. I'm guessing that if we had done this exercise sometime last week, the yen dollar, not 66, it might have been 70 or 80. And the CAD dollar, in fact, we don't have to guess. Take a look at the dollar CAD currency pair, August 8th. The RSI was at 71 on the dollar CAD. The dollar yen on July, that's going back to July. August 4th, we're looking at the RSI spikes to the upside, both at the same time roughly. Actually, let's compare apples to apples. August 8th, the RSI was 41. 41 on the dollar yen versus the dollar CAD at 71. If the dollar CAD was 71, it means the dollar was a lot stronger against the CAD. In other words, the CAD was a lot weaker. Well, 100 minus 71 is 29. So if we had run through this exercise on August 8th, the CAD dollar RSI, the inverse of the dollar CAD, would have been 29. Right now, it's 47. The dollar yen on August 8th was 41. Today, the yen dollar at 41, so 100 minus 41 is 59. Today, it's 66. So you can see, we've come off our extreme levels. But nevertheless, if we had run through this exercise, taking a step back, and we said, well, I want to trade a currency pair with a pretty strong trend, with the strongest trend, take a look at the dollar CAD. We went from highs at 82.65 on August 4th down to lows of 76.78, 82 to 76 at 600 points in how many days? Less than 1 week, 6 days. 600 points in 6 days. Now, the Kiwi Dollar, I haven't looked at these charts, I'm guessing. What were those dates I just talked about? Cad Yen, okay? High 82.60, the low 76.80, so that's 82 minus 76, that's 600 points in 6 days. And we're talking about August 4th to 11th, or 10th. August 4th to August 10th. Now let's look at the Kiwi Dollar. August 4th, we're actually up at 8,600, that big candlestick to the upside. August 10th, 86 to 80, to the 80 level. But that's after a very big move. If you take out that one big move, we're actually looking at 84 to 80, and the Kiwi Dollar is flattened out now. Maybe I'm not picking a good example. What's another example of something that's kind of close together? It's not a fair comparison because the Kiwi had a really, really big move that day. Possibly the dollar Swissy. Let's take a look. Dollar Swissy, August 4th. I'm trying to prove a point here. August 4th, 7,800 was the high. August 10th, 70. It's not letting me prove a point because the market has readjusted. But I really want to prove this point. So let's take a look at maybe, do I have the Aussie Kiwi? That might be a better example. Oops, wrong currency pair. New charts, Aussie Kiwi. Okay, so what do we say? August 4th. The high was 125, 126 actually. August 10th, 123. Okay, so this proves the points. You take a look at, I'll mark these lines off. I'll mark this area off so we can see what we're talking about here. August 10th. This is the Aussie Kiwi currency pair. Now the Aussie and the Kiwi, the reason why I picked those two currencies is because when we look at our list, from the strongest to the weakest, yen, pound, euro, Aussie, Kiwi, etc., the Aussie and the Kiwi are close together. Look at our exercise that we went through. The Aussie dollar was 51, the Kiwi dollar was 50. That shows us that compared to the dollar, the Aussie is 1 point stronger than the Kiwi. When you have two currencies that are both going up or both going down, when there's two currencies that are moving in the same direction, the currency pair doesn't move. Think of it as like a trader. If I want to trade a currency pair, I want to trade a currency pair that's going to explode. I want to buy, the dollar yen if it's going to go up 1,000 points, or at least has a potential to go up 1,000 points. The Rsi Kiwi, in the same period of time that the Cad Yen moved 600 points, or had a range of 600 points, 126 down to a low of 123, the Aussie Kiwi, which by the way is a much more volatile currency pair because you have larger spreads, it's much more difficult to trade. The same period of time, you only had a 300-point difference. If I'm going to buy two currency pairs, and I know one has the potential to move 600 points, 600 pips, the other has the potential to move 300 pips, which one's the better buy? I want to buy the currency pair that has the potential to move a greater amount. That's why the euro-pound is kind of a boring currency pair. And in the old days, the euro-Swissy and the pound-Swissy used to be a boring currency pair, and why the Aussie-Kiwi is. Because fundamentally, if we have a currency pair where both currencies are very closely related from the same geographic, political type of environment, Aussie-Kiwi, euro-Swiss, pound-Swiss, euro-pound, sometimes dollar-CAD, when both currencies tend to react to events in a similar way, it's good for Australia, it's good for New Zealand, vice versa, that currency pair doesn't really move. What's the currency pair that moves? The Aussie yen. High interest rates in the Aussie, low interest rates in the yen, stock market's up 300 points, the Aussie yen goes through the roof. Stock market's down 300, the Aussie yen gets crushed. Dollar Swissy. Gold goes up, the dollar goes down, Swissy goes up. Those currencies move in opposite directions in reaction to the same event. Sometimes the euro pound will be really, really trendy because good news in Europe and simultaneously really bad news in the UK or vice versa. This exercise will reveal those times. Right now, again, in order from strongest to weakest, yen, pound, euro, Aussie, Kiwi, Swiss, CAD. The weakest currency right now is the CAD. Fundamentally, we can kind of explain this because there's been some disappointments. The central bank statement that we read during our one of our recent central bank review webinars here on FX Street, it showed that actually it was 2 months ago that the Bank of Canada was really optimistic, and they said, we're going to raise interest rates, inflation is rising, GDP is rising, and then right after they said that, the numbers actually came out kind of bad. So the anticipation that the Bank of Canada is going to raise rates, and of course Canada, the Canadian economy is pretty closely linked with the U.S. economy. So maybe the fear that's gone through the U.S. lately with the debt ceiling and all that stuff, maybe that spilled over to the CAD as well. Also, Canadian economy benefits from high oil prices. They're a very large exporter of oil. Well, as the stock market went down 1,000 points in the past couple of weeks, oil went down as well. So that oil spill off, no pun intended. There we go. Here's oil. Here's the daily chart. As oil prices got crushed, we were at $100 a barrel a couple weeks ago. We hit lows of $75, $25, or in other words, a 25% move. Oil goes down 25%. That means that for all those Canadian exporting companies, their revenues potentially might have gone down 25%. Question is, how can we know which pair will swing the more pips in distance 500 to 1,000 pips? Well, Jack, it's a great question. I think this exercise, the benefit that it does is it identifies the currency pair that has a strong trend right now. Now, going back, and if you have a crystal ball, that obviously helps too. Assuming you don't, mine's broken. Going back to Milan's question though, if the yen is the most overbought and the CAD is the most oversold, logic would dictate that eventually, what currency pair has the best chance of a big reversal? That's the Cad Yen. Remember, the foreign exchange market is the largest market in the world. A stock might go from $1 a share to $100 a share. Well, that's an exaggeration. $1 a share to $5 a share in one day because most of the market just missed something. Or a stock may get cut from $20 a share down to $5 a share because most of the market just missed something. You know, inside information or whatever it may be, bad earnings, who knows. Foreign exchange market's not like that. You have to kind of assume that if there's any information out there, somebody knows it. And that somebody told somebody else, and that somebody else works on the trading floor somewhere at XYZ, a foreign exchange company, and he published a research report, and most of the market knows. Point being is that if there's information out there in the foreign exchange market, somebody knows, and chances are the market's reacted to it. There's no such thing as inside information in FX, for the most part. 99% of the time it doesn't happen. So how do we make money? We anticipate, first of all, we follow a trend that is in place. Trends in the foreign exchange market are very long-lived. The Cad Yen Trend, forget about the exercise we ran through now. The Cad Yen hit highs of 8,900 in April of this year. Since then, we've gone down to 76. That's 1,300 points or 300 pips on the Cad Yen in April to August. It's 4 months, 1,300 pips. Now, I'm not suggesting that we would have caught the top or the bottom exactly, but there's a lot of opportunity to catch the middle. Or if you look at a better example is what did we talk about before? This is the trend of all trends. The dollar Swissy. Go back as far as you want to go back on the dollar Swissy. I mean, we were a dollar Swissy. We were at 117 in June of last year. A year later, the dollar Swissy is at 7,400, 7,500, 117. I can't even do the math. That's 2,500, 3,500, 4,300 pips. 4,300 pips in 1 year and 2 months. That is, ladies and gentlemen, a trend. And that is not the beginning and the end of the trend. My point being is that if you're going to trade the foreign exchange market, find the trend and stick with it. Now, on a short and medium term basis, eventually we're going to hit oversold and overbought conditions. And the Cad Yen, I could see how somebody wants to buy the Cad Yen based on the theory that we're going to regress towards the mean. Always assume the market's going to come back towards the center. A stock might go up to $500. It might go down to $1 because most of the buyers and the sellers got on one side of the trade. But foreign exchange market, you know, the Cad Yen goes down. Eventually, traders are going to say it's undervalued. It's going to go up. People will say it's overvalued. The Cad Yen right now, I think, is a little undervalued. Now, where could it go? Former support could become new resistance at 7,900. We're at 7,820 something right now. Downtrending upper resistance is at 8,300. So yeah, the Cad Yen has a little or a lot of room to go to the upside. This exercise is going to help identify, first of all, what's a strong trend, and second of all, maybe if we're overbought or oversold. But given the fact the long-term trend of the Cad Yen is to the downside, I might try to buy it. I really try not to trade against the trend, in the case of the Cad Yen. But I really am hoping as the Cad Yen rallies up, because I would love to sell short again, because the long-term trend's to the downside. And so far, We have not broken any serious resistance levels. If history's any guide, if I was a betting man, I would guess that Cad Yen's going to go down more. Question is, do you have any tips to apply this method of trading intraday, such as 30 minutes, 1 hour, 4 hour time frames, for example? Yeah. I would first start with a daily time frame. It's a great question. First start with a daily time frame and identify those currency pairs with long-term trends. Well, I'm sorry, not long-term. A strong trend, like Cad Yen. Cad Yen has a strong trend. Aussie Kiwi's range bound. Write that down on a piece of paper. Cad Yen, long-term trend to the downside. Now, given the long-term trend to the downside, I'm going to really try my best to look for opportunities only to sell shorts. I don't want to try to buy the Cad Yen. I know it's oversold and it looks like it's recovering, and it very well could. But to answer your question, 30-minute, 1 hour, 4 hour time frames, it's up to you. I would pick one time frame that's of a shorter term nature and look for opportunities to sell short the Cad Yen based on the long-term trend to the downside. So if you go to the 4 hour chart, you have a look at the RSI, it's at 54. We're right in the middle of the range. 1 hour charts, the RSI is 58, in the middle of the range. 30 minutes, 59, we're getting up there. 15 minutes, even the 5 minutes shows us that we're not really overbought. Although, earlier today, if a real scalper, if you're looking to take a scalp in the Cad Yen, again, I only want to look for trades to sell short because it's in the same direction as the trend. And who knows, when I sell short the Cad Yen, either based on a scalping idea on a 5-minute chart or a swing trading idea on a 4 hour chart, the market could go down 10 pips, it could go down 100, or it could go down 1,000. But I know the probability is it's going to make lower lows more so than it'll make higher highs. I always want to sail or put my sails in the same direction as the big waves, the big winds, so to say. I wish I could think of an analogy. Stick with the trend based on the daily charts. Eventually, once in a while, you'll hit extreme overbought, oversold signals, but that's kind of rare. Most of the time, the market's going to go in that trend. So yeah, to answer your question, pick a shorter term time frame, but always do your best to trade in the long term, the same direction as the long term trend, barring those really rare instances like the Cad Yen just experienced in the daily chart when the RSI crosses below and back above 30. Then that's a warning sign that maybe, give the Cad Yen some time to retrace. Perhaps central bank circle may inside the trade market, which is, if you're referring to the currency wars that have been talked about so much, specifically the Swiss National Bank and the Bank of Japan, my belief is that even if all the central banks got together and tried to all buy the dollar at the same time, the dollar would go up a lot. But there's no such thing as a central bank or any institution that's strong enough to move the foreign exchange markets. It's like trying to change the direction of the tides in the ocean. Even one country, if we got all the people in the country to stand on the shores of the country and paddle their legs as fast as they could to try to make waves, they're not going to change the tide of the ocean. The foreign exchange market is the ocean. Maybe in the stock market that could occur, maybe even in commodities, but not foreign exchange. These central bank interventions, if nothing else, give us the opportunity to get a better position. I want to sell short the dollar yen or the dollar Swissy. I would love to wait for the Bank of Japan or the Swiss National Bank to intervene. Give me a higher price. If I'm going to sell short the dollar Swissy, I want to sell short as high as possible. So if you see an intervention taking place, they're very rare. If you see it taking place, don't trade during the intervention. Wait for it to settle out and then go back and look at the daily chart. Chances are, I think the long-term trend will stay in that direction. I was thinking about the central bank as well, as I know advance before the release. Well, yeah, but there's obviously very big, very important, very serious rules as far as central bankers not leaking any kind of information. You'll rarely, those are rumor that some traders knew that Standard & Poor's was going to downgrade the U.S. credit rating beforehand, but that Standard & Poor's is a rating agency. Central bankers, that information is locked tight. I don't think there's anybody out there that knows. It will it not help to calculate the average range of the pair? Yeah, absolutely. To do so, I would use the ATR, the average true range. That'll give you a very good idea about how far, or the Bollinger Bands, give you a very good idea of how far that currency pair could move. The central bank or the interbank circle, those are big players in the FX. They are. But again, foreign exchange market, it's too big for anybody to influence. Any reason why I choose 14 RSI? I like to see the indications that everybody else looks at. And I like to see when everybody else that uses the RSI says, hey, the RSI is overbought or oversold. I like to see what they're saying. I don't like to second guess what so many people have been using for so long. I don't think they can go any further down. There's no way Japan will permit $1 to 50 yen. It's true. It's true. Below 80 are big, big levels for the Bank of Japan. So not to say that I would buy the dollar yen, but I would not necessarily sell short it because I think at the bottom things get very volatile, and the chances are I don't think the dollar yen is going to go up or down a lot. I think that the fundamentals will push the dollar yen down. The Bank of Japan will buy the dollar dollar yen up, and then we'll have a range bound market. I have to go really quickly. As far as George Soros, he's really rich, but he's not rich enough to move the markets. Chances are there's not enough leakage in the market to influence the market. I really apologize if I missed anybody's question. I'm out of time though. All good questions. If you want to contact me directly, feel free to do so. www.forex. Sorry for the capital letters. Please see FX Suite's calendar. We have a lot scheduled ahead of us. Again, I want to thank you all very much for joining us. Wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back to